In today's video, I'll be talking about interest rates and foreign exchange rates and how um, investors make money doing this. And I'll show you many examples as well. So let's get started. So these are the parameters. This is a year. This is the Fed rate, Federal uh, Reserve rates, interest rates. I'm just using Japan as an example. Bank of Japan rates, dollars to yen, foreign exchange rates, initial investment, yield in dollars, yield in yens. This is yield in yens. There's a dollar sign on it, but for some reason this thing doesn't allow me to put the yen symbol. So this is the administration. This is positive or negative yield. This is for the investment in interest rates for this. This is for yield in for the total. This is a total yield after you convert it from USD to, in this case, yens. This is positive or negative for the investment for the total yield after you add this and this up, this and this up, and turn it into yens, basically. Well, let's get started. So in 2019 to 2020, the administration that was in charge was the Trump administration, and interest rates were lowered more than 95% in 1 year. And as you can see, the foreign exchange rate from yens to dollars, it was more favorable towards yens because you would get less yen for dollars in 2020 compared to 2019, right? So after a year, if you invested in 1 year treasury bonds, you would have gotten in yens you would have gotten 830 yen in yields, basically. So that would have been, let me see if that's right or not. Okay, that's right. That's yield in yens, right? Yield in yen. So from 2019 to 2020, it would have been negative 2.10% in terms of yen, in terms of your the interest that you got. But if you converted it all back to yen with your interest payment, it would be negative 3.84%. Because people here are borrowing money from the Bank of Japan, and they are basically after a year they're converting it from dollars to yen and paying it back, right? So 2021, 2020 to 2021, it would be positive. 2021 to 2024, that would be the Biden administration, because the interest rates for the Fed went up and the yen got weaker. As a result, you get a positive yield on the percentage of interest and also the whole amount, including the interest, positive 3.09%. So I just used this formula to tabulate that. I'll leave it. I don't think I could put this in the video descriptions because it's got brackets on it. Greater than or less than signs. That's not permitted on YouTube, but you could see here how I derived that. 2021 to 2022, interest rates stayed at 0.25%. Yen got weaker, so you could buy more yens with $1. So yen got weaker in 2022. So a Japanese investor borrowing money from the Bank of Japan at 0.24% and investing it in US Treasury bonds at that rate would have come out positive 20.17% for their interest, and also for the overall yield, same thing, 20.17%. So 2022 to 2023, the interest went up, for Fed rate went up 5%, a whopping 5%, while the Bank of Japan lowered their interest rates to negative 0.10%. Negative 0.10%, and the yen got very weak in 2023. So $1 would get you 151.65 yen. And in terms of your percentage yield in just for your interest rates, it'd be 14.89%. If you converted it all back, this is for the total amount. If you took it back to, if you paid back to the Bank of Japan that you borrowed from, your percentage yield is 20.32%. That's not bad in a year. That's very good. And high interest rate and weak currency. At 2024, interest rates is 5.5% for the Fed rate. But the yen got weaker. Yen got stronger than 2023, as you can see. And as a result, investors would have lost 4.86% if they would have converted that back to yen, that is, in terms of yen. For the total amount, they would have lost negative 4.36%. And let's see, in 2025 to 2026, let's say Trump becomes president again. We don't know if he will or not, but just say if he does, from the way that he behaved back in 2019, he dropped interest rates more than 97.1%. So if interest rates were dropped 97% from today's rate, it would be about 0.17%, okay? And that would result in probably a stronger yen, or foreign currencies would get stronger. And let's say Bank of Japan raises their interest rate from 0.25% to 1%, that would also make the yen stronger. So the people who invested their money in 2024 would have to convert it back to yens, right? Or yen. So this is how many yen they would get back for their total investment, which means they would lose negative 77.12%. That's a lot of money that someone would lose on an investment. And for the interest rate that was earned, even at 5.5%, they'd be losing negative 68.2%. This is a devastating loss, because the yen got stronger by more than, see how many times it got stronger. If that did happen, by 1.68 times, right? So let's say the next administration drops the interest rates from 0.17% to almost 0%. Well, then probably the yen would get stronger, and maybe the Bank of Japan would raise the rates to 2% if that did happen. Maybe if it didn't happen, maybe if it maybe if they raised it 1.2%, yen would get like, let's get a more reasonable number. Let's say 67, okay? For $1, you would get 67 yen in 2026. The people that invested their money in 2026 at 0.17% would have lost 28.35% in 2026. They would have converted it back to yen. For the total amount, the initial investment plus the interest rate, they would have lost 28.5%. So foreign investors buying U.S. equities or investments or bonds or whatever would probably diminish if a weaker dollar policy is pursued by the next administration. I think that would be pretty certain that if the foreign exchange rates for foreign currencies go up, then that would probably make foreign products less attractive because their currency is stronger than the dollar. But then that would translate to more inflation within the United States. That's the thing about it. So if there's more inflation in the US, then people here cannot buy stuff. So as a result, more of the stuff would be exported to other countries, right? For example, stuff like crude oil, LNG natural gas, coal, agricultural products and stuff like that would be more competitive. That would be exported out because there would be more inflation within the country because the currency is worth less, right? And that's good for trade, but that's not good for the people that live within the country. That would be inflationary. We're already seeing a lot of inflation right now, and you're going to see more of it. That's what probably would happen. It would be less foreign investments within the country. So if the dollar is stronger, that's good for foreign investors and if their currency is weaker, that's better because they could use the lower interest rates from their home currency, convert it back to dollars, and if the dollar continues to get stronger, they would be making more money here in the financial markets. So that's my 2 cents for today. If you have any thoughts, you could leave in the comment section below, and thank you for watching. Oh, also, I have something called Y2 and Y1. That's yield 1 and yield 2, basically. This is yield 1, yield 2. So if yield 2 is greater than yield 1, then it's positive, as you can see. This is greater than that, positive, greater than that, positive. This is less than that, so it's negative. Less than that, so it's negative. So you get back less. Less than that, it's negative. The same thing with yield in yens. Here to here, positive. Here to here, negative. Here to here, negative. So that's how I did all that, and I just used this formula to get the calculations and everything. That's pretty much it for this video. Thanks for watching.